Tom, what the heck's a naked short?
A naked short. So everybody knows when you're buying a stock, right? You can just buy the stock. You buy a stock of Apple. You're like, okay, I want one share at $100. If it goes up to 120, you make it $20. That makes sense, right?
Makes sense.
But you can also short a stock. You can also say, I think Apple would go from $100 a share down to $90 a share. So what you do is that you borrow a share from somebody else without them knowing. You sell it on the market for $100. Wait till it goes down to $90. Buy it back. Put the share back without the other person knowing, and keep the $10 difference. So that's called shorting. Works great if the market goes your way.
And this is
so when you naked short, usually you can short a stock if you already have some. Let's say you already have some of that stock, you can short it. So you're basically shorting your own stock. You're trying to make money on the downside without getting rid of your own stock. But if you short without having any Apple shares, well, if Apple goes up to from $100 to $200 a share, you still got to give back that share of Apple. So you got to buy it no matter the price. Doesn't matter if it goes to $1 billion. You got to buy that Apple share. And what's interesting is if you go long a stock, if you buy a stock, well, that $100 Apple stock can only go down to zero. All you can ever lose is $100. But if you naked short, what between 100 and infinity, you can owe anything. Definitely your home, definitely everything, all the money you've ever earned in your entire life, you can own, because if you short it improperly.
Okay, so naked short, it sounds like something illegal that you can't do. Sounds like funny business. You're borrowing something you don't got and you got to pay it back. It sounds illegal, so that's what happened, right?
There's good things and bad things about it. Sometimes it becomes illegal, sometimes it's not. It depends what point of history you're in. As you can imagine, when rich people want to make a lot of money, things that were illegal before now becomes legal. And when they lose a lot of money, they go, rah, 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 we got to stop this from happening. But currently it's legal, so you can short. There's good things about it too. So we won't get into that, but
of course,
suffice to say, it's not, shorting is not a weak person's game. You gotta know what you're doing.
Excellent. You sent me this morning, and then I thought, you know what? I hear a lot about paying attention to the financial markets these days, because what else is there to do? I hear there's a lot of retail investors, a lot of new people jumping in, a lot of people using apps and the technology we have today in order to go trading, people doing well, people losing their shirts. Robinhood, I think, is a word that's thrown around. I think that's an app that you can use, right? Is that
yeah, Robinhood, Wealthsimple, a bunch of these trading apps.
So, I remember when you get in here, you're learning the whole process, and then you get surprised by things, right? You didn't know that this could happen. You didn't know that behavior was working out. It's like, okay, somebody can teach you how to ride a bicycle, but you don't know, they don't tell you, oh, by the way, when you're riding a bicycle and you ride next to cars on the street, they might open their car door and you go flying, right? It's not in the manual for riding a bicycle. It might not be the obvious thing to tell you, but there's these dangers that are out there in the market. I like to think of the market as this huge ocean, and there's like sharks and things in there that can eat you, and you don't know. You're swimming there, you got your head above the water, and all of a sudden you feel a little tingle around your leg, and you're like, oh, what's that? Whoa, what? Huh? And then all of a sudden you get pulled down, and you're like, oh my God, I didn't know something like this could happen. Oh my goodness. So I thought, oh my God, there's a bunch of people out there. When it comes to Jumpstart, Jumpstart is a segment we do. It's about helping people who want to start a business or already have a business. And a lot of people are sort of independent contractors doing their own thing. I think it's entrepreneurial to go into the stock market. I don't know if that counts, but they might be in danger. And I thought, okay, there's got to be some basic things that they should know about. This naked squeeze thing is one. I've heard another word. I don't know.
Short squeeze.
Short squeeze. So is it a naked squeeze the same thing as a short squeeze?
No, naked short and a short squeeze.
A naked short and a short squeeze. Okay.
Yeah, a naked short is when I'm shorting something and I don't have those shares. So if things go wrong, I gotta buy the shares of whatever is on the market. That's why it's naked. I'm not covered by my own amount of shares. And a short squeeze is what's going on in GameStop right now, where a bunch of people who were short are now forced by a bunch of people who are long the stock. They're forced to cover their position. They're forced to undo their shorts. They're forced to go into the market and buy the shares and give it back to the people that they borrowed. But when you have a short squeeze, the price can go up so quickly that you can go bankrupt waiting for an opportunity to buy the stock back.
And often,
So a short squeeze is when a bunch of people squeeze it, and the price goes higher and higher and higher and higher and higher beyond any reasonableness.
I hear that. Correct me if I'm wrong. Again, I'm coming to this from a layman's perspective, so I feel like it's justified for everybody else who might feel the way that I do. I hear that when you short, you can borrow to short. Like there's a kind of borrowing that happens. Is that? Am I mixing that up with something?
Yeah, well, there's two ways you can short a stock. So we won't go into great detail on both ways, but you've heard of both stocks and options, right?
Yeah.
Yeah, so stocks is just a share of the company, a share of Apple, $100, and you own a share of Apple. The price goes up, it's great. Make a dividend, that's fantastic. But options allow you to purchase a little bit of Apple without actually buying a share. What you're doing is that you're betting on whether you think the price will go up or down in a given period of time. So think of it this way: you can bet on sports, whether a team will win or lose. But you can also bet on the spread by how much do you think the team will win and by how much you think the team will lose. And if you bet on a spread, sometimes you can get way better returns than if you bet solely on will they win or lose. Right, the winner loses more binary, and the spread is like not only do you got to get whether the winner it won or not, but you have to get by how much. So options in the stock market, not only are you betting if it'll go up or down, you're betting if it'll go up and down by a certain amount in a certain period of time. Now, as you can imagine, in order to make that bet, someone has to give you way better returns. You have to get a way better payout than if you just bought the stock outright. Because if I bought the share of Apple, I could just hold it for the next 20 years and I never have to, if it goes up over 20 years, I can make money. But if I'm buying an option and I'm saying it's going to go up by Friday, then I want to get paid back a lot more. So you can short, if you short with stocks, it's like we were talking about before. You're dealing with your broker. The broker says, look, Peter's got 100 shares of Apple. I'll let you borrow his shares, but one way or another, you got to put them back. And so that's one way. But options, oh my God. You can short in all kinds of different ways with options. And just like you can get great returns if you're right, you can get brutalized if you're wrong. You can owe far more than what you put on, right? So some people short, I'm not going to go through all the details, but basically, if you can lose if $100 Apple share goes up by 50%, goes up to $150, when you're betting it's going to go the other way on a short on the stock, fine, you got to pay $50 more for that share, right? You got to pay $150 out of $100, and now you're out $50 per share. That you can understand. But that same exact move in options, you might owe $100,000 on that $50 move, depending on how you make that bet. You can lose your house on that $50 move on Apple.
Kind of sounds like going into a casino and then you're getting down to the wire, you've lost all your chips, and then somebody comes up to you and says, hey, you can put your house on here and you can play some more.
Oh, worse, all right? So imagine you go to the casino and everyone, if you've been to a casino, you put your money down, fine, I hit on 17 on blackjack, I lost the money I put on the table. Imagine you sit down at the table and you never had to go and give any, put any money into exchange for chips. You just sat on the table and they go, we'll just keep giving you chips. You can just keep betting as long as you want.
Wow.
And at the end, if you win or lose, well, you redeem it afterwards. So you're not keeping track of your bets. And all of a sudden you get up and you go, oh yeah, you owe us your house. It's like, what? Yeah, you've been playing and you put a bet here and now you owe us your house. Like, holy Lord.
All right.
That's the kind of craziness that happens with options.
All right. So options, another thing that's illegal and shouldn't be, and funny business, of course, it's legal. If you get caught doing options, you go to jail.
Options are great. Options are actually better than stocks, in my opinion, because options are insurance policies. If a stock goes down and you expected it to go up, if you had an option, you might be really, really happy. But what happens in any insurance policy, some guy is paying to get insurance and the other guy has to pay out that insurance. So if you buy options, you can buy options all day and you're fine. But if you sell options To make that easy money, you sell the options. Well, when the hurricane passes by, you got to pay out. That's the problem. So you never, options are great if you buy them. Never, ever, ever, under any circumstances, sell options.
Tom, I feel like you just saved a lot of people some headache with that one. Have you ever sold an option before? You kind of sound like you speak from experience. All right, we won't get.
Well, I've never sold an option. I never sold an option in such a situation where I ended up losing my shirt, because before I learned about it, I heard all these horror stories that I did my homework. But oh my God, the stories of like some 22-year-old who gets in, they open up the Robinhood account. They we'll give you 10 free trades, and I'm like, great, and they put on their options. They're up this money, they're up this money, they're up this money. Now they're down $50,000. Happens every day. This kid the other day hung himself because he lost so much money with options. He was this 18-year-old kid, and he couldn't face the idea that he had to tell his parents that he lost all his money.
Can't you just go bankrupt? Like.
Yeah, when you're 18 and you don't know that, you think,
oh, that's rough.
That's
dark, man. That's exactly why I want to talk about this type of stuff. I mean, not exactly why. You brought up a kind of a dark point there, but it is true that people, could be making some big mistakes. And you see an opportunity. We talked about seizing opportunities. We talked about that. But also, I want people to understand the types of opportunities that they want to engage in, I remember being at a bar, at a club, a decade ago when I used to go out. And I remember this young woman walked up to me. Beautiful woman. She started talking to me, flirting with me, and I was like, "Oh wow, I was nice." I'm insecure. I don't talk to women, or I didn't at the time. And so she comes up to me, talks to me, like, "Hi, how you doing? You want to buy me a drink?" I bought her a drink, and we sat down at the table. And I was like, "Oh my God, this girl! She's sitting down, talking with me. We're having a fun time. She's clearly into me. I'm flying high.
I think I know where this is going."
And then a guy walks over. He's like, "Hey, I need money." And I was like, "Huh? What?" And that's when I realized this girl's a prostitute. She's a sex worker. Nothing wrong with sex working. I didn't know I was engaged in I didn't know somebody's going to come calling, looking for some cash. So, even you go out, you see an opportunity, a nice young lady, you decide to seize upon it. It could be something that's dangerous. And in the stock market, you see an opportunity. Here's an app. I can put some money in here. Here's options. I can make some quick money. And then it could turn out to not be so great. So I know offline we talked about risk management. And I thought it'd be a very good lesson to learn, especially today, people getting short squeezed with the GameStop. So in this part here, I want to talk about financial literacy. I want to get people just to get a cursory idea. I mean, maybe you've never even heard of these terms before. Okay, so I want to shoot another one by you. We talked about the naked short. Did I get that right? All right, cool. Short squeeze. Yep. That's pretty cool. And then so valuation. What does that mean?
Yeah, that's a term that sort of makes economists laugh right now. Valuation before is what should a company be valued at. So if you imagine a textile company, then you go, okay, the valuation of the company, at minimum, they're worth whatever you can sell the factories for, whatever inventories they have, whatever IP that they're holding on to, patterns or anything like that they hold on to. You go, okay, there's at least that. Then you go, how much money is that company making every year for the last 10 years, and you extrapolate that into the future for the next 5 years. You do some basic math, and you calculate, well, this is how much I would pay for this company, and so I divide that by the number of shares that are there, and this should be the share price, depending on if this trend continues, and that makes sense. So that's why you're buying $100 worth of a share of Apple might be $100 because it's pricing in. This is how much Apple will be worth in this period of time. Well, what do you do when a company like Tesla or anything like that is trading the price that you're paying for the share far outpaces the physical assets that they have, the intellectual property that they have, the cash on hand, the money they bring in. Some of these shares are like 10, 20, 30, 100, 1,000 times more than what the valuation than what they're at. But you got to know what to value something at, right? If you're going to buy a share, sure, you're buying a share of a company because you think it'll go up in value. You got to know, well, what is it do I think it'll go to? If you don't even have any idea, then you really shouldn't be buying the share. I'm not saying you need to, do the math yourself, but at least check, reports and get a consensus of people that you respect. Just have some idea of it, because the stock might be, if you bought, let's say, Microsoft at the top of the .com bubble, right? Microsoft is still around now, a very profitable company, but it took you 10 years after the .com crash for the price of Microsoft to get back up to where it was in 2000. So that would have been a bad time to buy it, even though, it was going up for years. So you got to know what valuation is. What should this company be valued at, and what should I be paying for this company?
Sounds like common sense. That's very good. Valuation. I've heard that on CNBC. I've heard Mr. Kramer talk about that. So thank you for explaining that. And lastly here, margin call. Sounds dangerous. I've seen that movie.
Yeah. Yeah. So if you're normally invested in like some sort of a retirement savings account or tax-free savings account, you're not usually dealing with any type of margin, right? What if you put $1,000 in, you're investing $1,000, you're just, all you can lose is $1,000. But when you're dealing with a margin account, what that means is that the bank allows you, the broker allows you to have if you have $1,000 in your account, it'll allow you to borrow from them on credit, let's say 50% more than what you have, 200% more than what you have, 300% more than what you have, right? So $1,000 you might be able to do 3 times that. So that means you're able to buy more shares than you would have normally.
And this is different than the options.
Sort of, but we won't go into all the difference about it.
But this is
sometimes it's the same, sometimes it's...
But this is for stock. So once you're buying shares in a company, just straight up, I'm buying shares. I can buy shares on margin, meaning I get credit for this. That's more like the casino example where I can place a bet by selling my house type of thing, or...
Yes, by putting your house up as collateral, let's say. But in this case, what it really is that the money in your account that you have in your broker account, that's the collateral. Mm-hmm. And if you keep a certain amount, like the broker might say, you have to have at least 10% of your bets you have to have that much cash inside your account. So if you have that in an account, you can bet 1,000% more than what you have over there. And so basically, you're buying shares on credit. Right?
Yeah. Okay.
Now, if you're buying the shares on credit and the stock goes up, no problem. You sell your shares, you make some money, and you're happy. You bought more shares than you could have otherwise. But if the stock you buy goes against you, now all of a sudden your account that had a portfolio value of $5,000, now you're down to $4,000, and the bank might say, your $1,000 that you have as margin is not enough. We need you to put another $1,000 in. We need $2,000, right? Now, if you have that extra money to put in, that's what's called a margin call. They're saying, hey, your margin here, we're doing a call. You're gonna have to put more money in. If you put more money in, then no harm, no foul. You just continue with your shares. But if you don't put the money in the appropriate amount of time, then they sell all the shares you bought, and whatever you owe, you got to pay. You got to pay up. You got to cover your margin. You still owe money to the broker, to the bank.
So. Why is it a margin call? Why isn't it like you just always need this percentage for whatever you're borrowing? Like, why do sometimes they don't do a call? Like sometimes you don't need to put that extra $1,000 in?
Yeah. So the call really refers to when they used to like give you a call. Hey, Mr. Hartman, we need you to put another $1,000 inside your account. You're literally getting a call. Mm-hmm. Call for it. Now it's more like it pops up on your computer. Oh, you need to have this much money, but it's vestigial. But the margin is how much margin? How close are you to not having enough collateral to cover this? Cover the minimum collateral amount for this position.
Tom, thank you so much. Jumpstart, you've just given us an education here, a little bit of an education. We've heard about the naked short squeeze, valuation, and margin call. We got just a tiny little dose of financial literacy put into our brains here. Next time we can hear those terms on the news and on CNBC or whatever you watch or YouTube channels, you might understand a little bit more. You might not dive into depth, right? And maybe we'll talk about it more as we go. This is just cursory, but look, all I had before this was a Wikipedia read. So thank you for giving me that, Tom. Hey there, folks. Hope you had a good time here today. Hope you enjoyed learning. I really like learning. Look, you might be the type of person who's like, I don't really care about finance. I don't care about stocks. You should. I mean, a huge part of our system depends on it. And if you want to understand politics, if you want to understand education, if you want to understand healthcare, if you want to understand things, you got to understand how money flows. And so I think it's very important, which is why I included it in the show, which is why we included it in Jumpstart.